Welcome to the Lean Marketing Podcast. I'm your host, Allan Dib. Today, I've got a very special guest. He helps entrepreneurs exit for 8 or 9 figures, the biggest payday of your life. You might think of him as the Sherpa who's going to get you to 8 or 9 figures, your biggest ever payday. Welcome, Nick. Great to have you on, and thanks for making the time.
Hey, Alan, thank you. Good to meet you as well.
Why don't we start with who are you, where are you from, who are your people?
I started and sold my first business when I was 21, and I sold it for 3,000 Australian dollars. I then went into the world of corporate and I worked for News International and some of the big media companies around the world for a number of years. And then I moved to the UK in 2003 to work with one of the biggest, in fact, the second biggest consumer publishing group at the time in the UK called EMAP. And I started to get involved in mergers and acquisitions while I was there because this was a huge company. In fact, it was the last company to be sold, a big exit before the market crash in 2008. And it sold for over £2 billion to a private equity firm, and it got broken up and all sorts of things. So I learned a lot of what I do now, in the early 2000s. I then went from there to a business called Getty Images, which was a huge learning experience for me. We did the owner of that company said to me, we do things differently, Nick. We don't just grow organically, we grow strategically. We buy and sell companies. And I was involved in 40 transactions while I was there. And that just took me on a path into the world of private equity, going in and fixing businesses, scaling businesses, taking them all the way through to exit. And I've been doing that now for I did that for 10 years. And the last 5 years, I decided to make a transition. And now I work exclusively, as you said, with founders who want to target an 8 to 9 figure exit at some point, in their future.
In the last couple of businesses that I've sold, the thing that really got us the blue sky valuation was having some proprietary intellectual property. And that got us a valuation way, way above just a normal industry earnings multiple. We got way more than we would have just based on the revenue or the customer base. It's because the acquirer could see, hey, if I buy this intellectual property, apply it to my other business, we can get this kind of margin uplift or, benefit or whatever. And painting that kind of blue sky picture gets you a much, much bigger valuation.
There are 15 things that are absolute, and there's a bonus, and the bonus is actually the proprietary IP, because not every business has to have the proprietary IP, but if you have that, it can give you a kicker on the multiple.
Yeah.
If I'm a private equity guy, particularly coming in to buy your company, what I would call a sophisticated buyer, I'm doing transactions all the time, right? There are a number of sort of lanes I'm going to look at, and at least 3 or 4 of them are marketing or brand related.
Yes.
And the more unique, remarkable, differentiated you can make yourself, right, and position yourself as effectively a category of one, if that's possible, or certainly as close to that as possible, that's going to increase the valuation as well. So if you've got what you said, some form of proprietary IP, be that methodology, products, even service, however it's done, plus you've got a unique and differentiated brand, then, it becomes, if you just think about it logically, you're going to be more valuable because you're the only game in town. I often say to people I advise, and this is a really important point, is a sophisticated buyer is going to try and value your company based on the financials, the numbers that you present under NDA. So usually it's a multiple of EBITDA or profit.
Yeah.
However, if you really want to win, and this is kind of going behind the scenes, you want to work on their math, not yours. And their math is what you're articulating now. It's what they can do with what you've created. And there are ways of getting that information out through the whole process of due diligence and negotiation if you ask the right questions. And you can, if you've got a really good finance person on your team who's helping with the process, you can start to run numbers that show the value that you will bring to that company. The way I sort of say to people is you won't win the full amount of that value. But if someone says that your business is worth 5 or 6 times profit, and your business is going to be worth 10 to 12 times when it's been acquired by, say, another company, you can certainly negotiate a couple more points up. And if your EBITDA is, say, 5 million or something like that, you've just made an additional 10 million in enterprise value for yourself.
Yeah. What are the small hinges that are going to be swinging the big doors here? What are the things that are really going to move that needle on the valuation?
Yeah, so what I often say to people is, and Daniel Priestley talks about this a little bit as well, when he says, you've got the lifestyle business versus the performance business. Yeah. And it's worth making a decision at some point in your entrepreneurial journey, which lane you're going to go down. You can pivot if you want to, but they are very, very different outcomes. And I start with that because I think, a lot of what I'm going to go through now is about choices you need to make, right? So if you're going to build a lifestyle business, you're going to focus on taking money out of that business to support your life. You're not probably going to be investing as much in growth.
Yeah.
Those businesses can be sold, but they're not structured to be sold. They're structured to support you in whatever sort of personal capacity you have around that, your income. Performance business is often one that is, relentlessly built for a transition. And, often they're the businesses that raise money, be that venture or venture capital or debt. And as soon as you bring investors in, then, the pathway is that you're going to sell the company because that's what the investors are investing in, that sort of liquidity outcome. So if you go down that path, let's talk about that. You've made the decision that you are going to build a business to exit. And what I often say is you've got to start to get clear on what that number is going to be for you and then reverse engineer from that. So let's say you want to sell 50 million. Well, you've got to understand a couple of things. Half the valuation or 40% of the valuation is going to be based on your EBITDA. Okay. And people ask me, can you sell a business based on revenue? Yeah, you can. But these days, particularly when, money's harder to get, interest rates have gone up, you're better to focus on profitability. So to achieve a figure like that, a 50 million exit, you'd be wanting to get your EBITDA up to around about 5 million to around about sort of 7 to 8 million as a range. But as soon as you get to 5 million of EBITDA, you open up the what we call the mid-market of private equity. So private equity guys don't like to do deals that are small, but as soon as you get to about 5 million of EBITDA, net profit, you're sort of hitting the top of the bell curve. And there's a lot of private equity firms that have capital that they want to invest in businesses that get to that size. Now, at that point, you're probably looking at anywhere between a 40 to a 60 million valuation just on the profitability of the company.
Right.
Okay. Because I think it's important, because a lot of people say to me, oh God, what? So I might be at 1 million of profit now or 1.5 million of profit now annualized. All I need to do is get to 5 million and then I'm going to open up all these options. And the answer to that is yes. The way I look at it is one half of the coin is financial. It's the numbers. The other half of the coin, there are, as I mentioned, 15 different things you need to think about as you're building the business to maximize the multiple. So the way I look at it is that every market has a range. So in education right now, the range for a business that's doing, say, 5 million of EBITDA, so the profit's the same, the range is anywhere between 6 times that 5 million and 14 times. And now you've got to be thinking, well, hold on, it's the same profit. Yes, it's the same profit. But one business is worth 30 million. The other one is worth, 14 times 5, right? So you can start to see that this is getting a bit crazy. Why is one business worth 30 and the other one's, pushing north of 100? So one of the things, of course, is what we call transfer value. And this is a business that isn't reliant on any one individual. So if you are the cog in the wheel, right, literally, marketing, sales, delivery, all of that is reliant on you, the founder, because you've built the business that way. You might like to be the person who's the best at everything. Lots of entrepreneurs, with egos get like that. That business is very, very hard to sell, certainly to private equity, because private equity want to have a machine. They want to have a system. They love structure and process. So you have to build a leadership team. You have to build the right structure so that the business can transfer and isn't reliant on you.
So let's say you're doing about 5 million or up to 10 million in profit right now. Do you wait for someone to knock on the door or do you proactively approach them? How are you starting talks about a deal?
Great question. And most people at that position go and hire an investment banker or a corporate finance person to effectively act like a real estate agent to sell the company. My belief is that proper exit strategy is a 12 to 36 month process where you get very intentional about the things I've been talking about. When you get into that sort of last 12 months before you want to officially, say, put the business on the market, my belief is that as the founder, you should have replaced yourself as the CEO of the company at that point, or certainly replaced yourself as the person who's running the company, even if your title was still the CEO. And you should be going out there and meeting potential acquirers, but, and this is the most important thing, without the intention of selling. So you want to sell, they want to buy, but you're not out there brokering the business. You're out there learning about the industry with the intention of that, you do want to sell the company at some point in the future. Now, subtle, but super important, it changes the whole energy. So how do you do it? Just to be practical, you go to trade industry events where there are always investors going to those. You might even go to a private equity event that's specializing in a certain industry, and you could speak on stage, or you could just go there and network. If you have a really clear view that you'd like to sell your business to another bigger business within your industry, you approach them with the guise of a partnership. And most partnerships turn into acquisitions if you know how to position them correctly. So these are all little secrets or tricks that you can start to do, again, once your business is ready for that next step.
Yeah. So I often think of, someone like Tony Robbins, who's built just this massive machine. I mean, if you think of someone who's in the information, education, coaching sort of business, I mean, he would probably be pretty much at the top of the heap. So if he came to you and he said, Nick, I want to exit, or I want to look at a succession plan or whatever, what would you do?
So I think if he wasn't so front and center on his core programs, and he created programs and products which had their own positioning and value, and it was under Tony Robbins International, I think that's an investable business. I think where it's at now, though, he'd have to make more shifts versus what he's currently doing to be able to do that. I don't think the brand Tony Robbins International is necessarily a bad brand to be acquired, but the way he's currently structured, he's positioned too much as the cog in the wheel.
Yeah.
And as a result of that, it makes it very, very difficult for an investor to see value there.
Yeah, yeah. And post-exit, I mean, there's usually deals where, hey, you'll stay on and make a smooth transition where...
Yeah, 100%. People sometimes ask me, why would I sell to private equity versus selling to another company? And there's one really big reason, and that is what we call the sort of 2 bites of the apple reason, which is if you sell to private equity, you don't often sell the whole company. You sell somewhere between 70 to 80%, and they get you to roll over into the new entity that's created. Yep. If they buy your company and you still own 20% of it, and then they want to sell that, in 3 to 7 years, I've seen situations where a founder takes a lot of money off the table in the first exit. They stick around for 12 months doing the integration. Then they join the board and do what you just said, like, do some kind of stuff that's brand related, but they don't do any business operations because at that point, someone else is running the company under private equity ownership. They still have their 20% at the same share level as the private equity firm. That business grows, sells, and they make more, sometimes more than what they made in that first piece. Doesn't happen all the time. So I don't want people to go like, that's what happens, but it can happen if you're very conscious about that.
So on that point, which is sometimes commonly referred to as the golden handcuffs, that is the good scenario. But a very common one is, you're like, I hate my life now. Like now I've got a boss. They're destroying what I built. They're bringing in some manager and I don't agree with what they're doing. They fired people I love, So how does that play out?
I'm going to go back to what I said about you've got to really think this through and learn how the game is played. If the goal is to sell your company for 8 to 9 figures, you've only got really 2 options. The IPO isn't really a sale, it's a capital raise. Yeah. So you've really only got the option of selling to private equity or selling to a strategic buyer. Yeah. If you sell to a strategic buyer, we often call it a turn the lights off strategy because quite often they don't really need you, right? Particularly if it's a big company, they just want the assets that you've created. So in those situations, if you don't want a boss or you don't want to kind of stick around, that's a really good exit for someone who just wants to kind of like integrate into a bigger mothership and, let their business do whatever. The issue with that is there's not a lot of protection for the people that have got you to where you are. And, you don't obviously have other opportunities to create wealth through that. But it's a choice. Now, if you go to private equity, you are going to get a boss and you're going to have a board put around you and you're going to have an operating partner like I used to be telling you what to do. But there is a kind of caveat that I don't want to muck things up from my side. I want you to be supported. But if you're not doing what we want you to do, then you're going to be out. Right? And that's what I mean, the unapologetic about money. We don't care about, how great you were when we bought you. We now own you. So what I say is if you're going to sell your company and you've got this intention and you give yourself at least 36 months to understand how the game is played, do all the exit preparation I mentioned, and go out there and handle the process yourself, you can pick and choose who buys your company. Now, most people don't think like this. They go, oh, I'm just going to take the highest amount of money. Whenever you sell anything, there's two pieces. There's price and there's terms. And you can only win one. So my point B here is take your time to learn the market. Take your time to decide whether you want to be strategic or financially acquired. If you choose financial, go out there and find the key private equity firms. Go out and meet them. When you go through the process of, selling your company, get some due diligence on your side from people that have, already been acquired by that company, and try and find some ones that weren't or went through the process and didn't have a good time. So you should absolutely do your own due diligence before you sign the transaction.
Yeah.
And in that situation, you can mitigate some of these issues, because there are great private equity firms out there that are absolutely aligned with probably what you want to achieve, but they're not just going to show up. You've got to do the work to find them.
Yeah. Would it be true to say that you want to be happy with whatever the first chunk is, so that you can potentially walk away or get fired or whatever, and not get that second chunk, and you'd still be happy with the transaction?
Yeah, cash at close. So yeah, I often advise my clients on, I say, listen, when we sell the company, you're going to have an earn out, you might have a rollover, in those things, but we want to make sure that the cash at close is what you want.
Yeah.
And anything else is a bonus.
Yeah.
And that's again why it takes longer to get a business ready, and you have to go for a bigger number, because, as I said, you'll get 70%-ish cash at close on a private equity transaction. So you want that to almost be your life-changing number.
Very cool. Nick, thank you. You've been very generous with your time and your knowledge. Thank you so much, Nick.
Cool. Thanks, Allan. Appreciate it.
Thanks for tuning in to the Lean Marketing Podcast. This podcast is sponsored by the Lean Marketing Accelerator. Want to take control of your marketing and see real results? With the Accelerator, you get proven strategies, tools, and personalized support to scale your business. Visit leanmarketing.com/accelerator to learn how we can help you get bigger results with less marketing. And if you enjoyed this episode, please leave a review or share it with someone who would find it helpful. See you next time.